Hey everyone, today I'm excited to be talking to Chris Lopez. He's a Denver-based investor and entrepreneur who's really built this impressive real estate career. We're going to talk about this today. He started by building an active rental portfolio and then eventually transitioned over into the passive side of investing. By the way, he's the co-host of the Passive Pockets podcast, which I've been a part of. Again, that's the Passive Pockets podcast. And he's the founder of Property LLaMA Capital. We're going to talk about that. First of all, I'm just curious about that name, first of all. And he helps hundreds of landlords make that same shift from hands-on property management to more freedom and flexibility through passive income. It's something that I can definitely get behind. I'm excited to be talking to him here today, share his journey. He's going to talk about some of the lessons he learned, and then ultimately how he made that transition successfully. Chris, how you doing?
Peter, I'm doing fantastic, and thank you for having me on.
Yeah, I'm excited to talk to you because, again, the last time we talked, we were on the other side. You were doing the interview. I was being interviewed. And first of all, it was an honor to be on your podcast. I mean, it's incredible what you guys have built. Just tell people a little bit about Passive Pockets podcast, which is hard to say sometimes, but tell people what that's about.
Yes, first off, don't say it 3 times fast.
Yeah.
So Passive Pockets is a new division of BiggerPockets. They acquired a company called Left Field Investors, and they wanted a brand, a division, a voice, a community that just focused on the passive investor, right? A lot of they call them BP graduates. A lot of people, started with nothing and built just amazing rental portfolios with, BiggerPockets helps along the way. And a lot of them are now wanting to go passive. So Passive Pockets is their community for helping people learn about passive investing.
I mean, I think it's incredible. And I think it probably mirrors your journey a little bit. Let's talk about that. You mentioned how you started in active and then went to passive, but how did you even get started in investing to begin with? Is that where you always imagine yourself doing? Was that a career for you, or how did that happen?
Oh man, I'll have to really rewind the clock now. So, I'm in my early 40s. So this is, just a little over 20 years ago now, or more than that. So I went to college to be an engineer. I went to Virginia Tech to be an engineer, realized in the very first semester, engineering was not for me. And so I kind of started trying to figure out, what do I want to do? I ended up reading Rich Dad, Poor Dad, which completely, changed my perspective on entrepreneurship and investing one day. And I was like, oh, wow, I want to get into real estate. Well, that lasts like 3 months because this was 2002 timeframe where there was not YouTube University and all these amazing resources, right? So I was like, okay, I want to do this, but I got to make money first. So I turned to business. And back then, the internet was a very early stage growth, but as AOL CD-ROM still was the hot thing.
Yeah.
You remember those, Peter, right? So I got into internet marketing because, hey, I need to make money, and that's a business I can do as an entrepreneur. So I built a successful internet marketing business. Once I got to a good point, I was starting to do some day trading in the stock market. Hated it, sucked at it. So this is not for me. And then, great financial crisis happened with the 2008 meltdown. So I was not in real estate. My business still, indirect headwinds. So my income, dropped. I hated the day trading and realized, hey, this is a time for me to get into real estate. My business is starting to wane off. The market is crashing. Best to ride the trends on, right? Just if I buy low and it recovers, I'll make money in 5-10 years. And so I shifted over to wanting to invest in real estate and then also wanting to start a new business in real estate as well. And so this was 2010 timeframe.
I mean, how did you even know how to get started at that
time? Fail forward, go out there and try a bunch of things and see what works. So what I did out there, I kind of fell very fortunately first in doing my first deal. This was late 2010, I believe. We closed January 2011. Was looking at Reno, Nevada, buying a condo for $67,000. 3 years before, they're trading at 220, 230, 240 range, right? So I'm buying for a third, buying it foreclosure. And then I actually ended up doing my first creative financing deal where I was like, hey, I want to do this. Prices are low, talk to their friends, just kind of sharing my journey and also pain points, right? Was it's hard to get financing back then. And so then a private investor did a 5%, 15-year fixed zero down loan. So I got my first property zero down, which was, an amazing experience and gave me lots of confidence. But that was just me feeling for hey, this is cheaper than my rent right now. This is stupid not to buy was my first. It was hey, I can buy this place and it'll be a third of my rent. And plus I'm buying an asset. And I just started talking to people hey, how do I do this? I have no idea. And here's how you do it. And do you want some money?
I mean, that's incredible. I mean, think for a lot of people that are listening to this, again, you came from this whole professional background, even just wanting to be an engineer and kind of having that mindset. I think for a lot of people listening to this, we have a physician community who oftentimes like really analyzes these things to death. And it's hard sometimes to make that first step because you want to make sure it's perfect. You want to make sure you don't make mistakes. You don't want to, again, like you said, fail, but somehow you were able to get over that. Like, I know that you said you just do it, but was there anything more to that? Like, how did that actually,
Well,
how did that actually happen?
yeah, I think from a mindset standpoint, just as it all comes down to risk reward, right? So for example, my wife is a veterinarian, and Wednesdays, and she's a general practitioner. Wednesdays are her surgery day, right? When you're in surgery, it's like you have high consequence, right? Like that's where you have to be perfect. Where I'm like in marketing and business and real estate, I'm like, is this gonna get me sued? Do I go bankrupt? Do I lose my house? Like no. And a lot of us like, okay, I maybe lose some money or waste some time. Like there's very low risk in my opinion, right? It's not like life threatening and it's not financially threatening to like me and my family. If it is, okay, I usually don't do it. So a lot of me is just kind of taking the logical approach of, hey, this is a high reward, but low consequence. And then from there, I'm just a big proponent of when you have an idea, pull a thread, talk to people, research, and then go out there and try to create opportunities. So people here are great. I bought this property. And then in 2016, 2017, I became a real estate investment broker. And I did hundreds of millions of dollars in transactions with a great portfolio. But you don't hear about those four years in between of eating dirt, right? And that's where I call failing forward. I did fix and flip, made money, hated it, realized that was not my path to scale. It was way too hard to scale that business. Became a multifamily junior broker for, I don't know, 100, 200 days or about half a year. Realized, hey, this is all sales and just make 300 cold calls a week. It was working hard, but not working smart. I was like, I know how to do online marketing. Like, why am I just making cold calls all day? So then that took me the next progression. I went out there and I had a previous client from my internet marketing business. And he was just stud in Las Vegas, 40 flips a year, owned a bunch of rentals, vacation 4 months a year, just had that real estate poster boy lifestyle, right? And he's like, hey, all my business comes from my network and I do direct mail and do internet marketing. So I tried internet marketing and I was like, this is awesome. I'm the variable in here. When it happened, Peter, I got crushed. I'm like, I was really, hey, he's a successful person. He's got this thing. Let's do online marketing. And this was back when Open Door was bidding crazy numbers. But I was like, wow, this is a very hard business to do. Yeah. My plans of copying, pasting that in Denver, I was like, that's not the right thing to do. So I tried all these things. And I realized, hey, I bought this rental. I'm making money in like that 3 to 5 year ownership period. My college degree is financial planning. So I started working as a real estate investment broker. And that's where I kind of found my traction after I had 3 or 4, I'll say failed or false starts, figure out to be an entrepreneur.
I mean, it's a pretty incredible journey. And so you started building your portfolio from there. I mean, it sounds like a lot of twists and turns, but then you started building your portfolio and I know you found some success in that. At what point did you decide, all right, this is also not necessarily the path for me, or I kind of want to add to this or pivot or something like that? When did that happen?
So that started happening in 2019. So 2 big things were happening where I built a successful portfolio. My brokerage business was just cruising. But both things were going great. I had 2 personal headwinds. I had my second child along the way. So I was just getting, less time and less sleep, right? And then those are very precious resources. And then the numbers were just getting tougher to make sense from like a rental standpoint. Like prices had gone up a lot, rents were quite keeping pace. And people forget, hey, before COVID, interest rates were starting to drift upwards back then. So, numbers were getting tighter in 2019. And I was like, man, for the effort I put in, and I was a light value add guy, a property that needs, a little fixing, I can add value, some light facelift. I can go in there and just add a little value and create some cash flow and create some appreciation. And you can do that, a few hours a week. And I was no longer like finding the deals and having that, hey, cool, I'm doing all this work and it's worth $20 an hour, right? That's not a good use of my time. But I think that's a good tip for everyone, especially you doctors who are very high earning professionals, right? Like, hey, this activity at least paying you more than your job. If it's not, and ideally like 2 to 3x more than your job, I was like, hey, I'm paying less than I can make in a job. This is not the right thing for me. And that's when I wrote my first check as an LP into a multifamily value add. It was a small check just to learn. But after a year or two, I was like, wow, I got these same or better returns. I did no work. So I still bought a few rentals, started investing a lot more as an LP. And then 2021 or 22, I stopped buying rentals. And then I started selling some rental properties after that. And I've been taking new cash to invest. I've been selling some of my properties and investing the proceeds. I've also set up a couple like self-directed retirement accounts as well to invest passively. But my pain points were numbers stopped working, and I want to spend more time with my family.
I mean, was there any part of that that was actually a challenge for you, going from
Oh, absolutely.
running it all to having that control to like just investing passively? I mean, it sounds like it was a big win. You started making good returns. You didn't spend as much time, but I don't know what part of that might have been an issue or a challenge for you.
Well, I mean, there were definitely a lot of issues and challenges on there. A lot was just typical thing that real estate investors have is you give up control.
Mhm.
And that's like the hardest thing, right? We tend to be control freaks. And when you're an LP, you have no control. You're along for the ride. Massive pluses or minuses. So kind of going through my own, mindset therapy for that. And the how I got to it was, in my opinion, was a very logical conclusion, right? Because I'm all about like, hey, I want to achieve this outcome. There's opportunity in bigger multifamily on a scale. What does it take for me to get there? I can run as a solopreneur buying, single families and fourplexes and running that with, a third party PM and a couple of vendors and bookkeepers here, right? I can do it as a solo entrepreneur. Taking down a bigger apartment complex, you get to have a lot more moving parts.
Yeah.
And I'd see these friends who I was investing with, they had, a 5-person asset management team, 10 to 20 people on construction, at least a few people on PM or dozens of their in-house. And I was like, wow, that's the business it takes to build on there. I don't want to do that. Nor is the best use of my time. So logically, I'm like, hey, if I want to retain control and hit these numbers, that's the path forward. But I was like, I don't want to do that work. So I either have to like commit to doing the work or say, hey, I'm not going to do the how. I need to find the right who. And so that kind of saw what it took to build. And the majority of my investments have been with people that I've known very well throughout like my Denver network, right? Everyone's done deals together or 2, 3, arm lengths apart. Everyone's done deals, the good, bad, and ugly about people. A lot of crossover, I know their staff. We've done the deals together, things like that. So I have a high faith in their ability to execute on what the organization does. And that's how I got past I need to be in control because you can do better than I can. And you have enough best interest where you give a damn.
Joining a mastermind group was a pivotal moment in my life. Within the first year, my income tripled, and by year 4, it had increased 20-fold. But the benefits went far beyond financial gains. I found myself surrounded by a network of like-minded individuals, forming connections that would become lifelong friendships. And the collective wisdom and support from this community played a crucial role in my success and personal development. From these amazing experiences, I felt a strong desire to create a similar community for my colleagues and peers, and that's you. That's why I launched Momentum MD Mastermind. People have been asking what this is. Momentum MD, or MMD for short, is designed to offer the same transformational powers in both personal and professional growth that I've experienced. It's not just about increasing your income. It's about creating this amazing environment where you can thrive, learn, and grow alongside other ambitious and supportive like-minded individuals. MMD provides a space where members can share their challenges, celebrate their victories, and push each other and keep each other accountable to reach new heights. It's about building a network of professionals who are committed to helping each other succeed. We focus on actionable strategies, accountability, and fostering an environment of continuous improvement. So whether you're looking to advance in your career, start a new venture, or simply find more balance and fulfillment in your life, MMD is here to support you every step of the way. Now, if this resonates with you in some way and you're interested in learning more, we'd love to hear from you. To learn more about the Momentum MD Mastermind and to pre-apply for a call with us, please visit MomentumMD.com. Let's see how we can help elevate your life to the next level. There are limited spots, so don't wait. Take the first step towards your transformation today. You won't regret it.
Yeah, a lot of high income professionals, you're right, experience that same challenge where I think a lot of people get into owning their own rental properties, and I did too. And then you start to think about your time. And then you start thinking about the energy you're putting in. And then you start to realize like again, this is not for everyone because again, there's some really great benefits to it. But that you didn't really want to have a second job. That wasn't the goal. And in some ways for a lot of us, especially medicine, like, we could do a lot better if we just picked up another shift or did something like that and then poured it into some other place where it could grow. And it sounds like you went into that and you kind of had that analysis going. And I've heard you talk about something called the return on equity analysis. And I think you kind of almost like solidified that or made that clear for people. Like, what does that mean for you? And then I think it's something that could be useful and beneficial for other people. If you could explain it.
Oh yeah, this is a topic is near and dear to me. So again, this is a lot like my financial planning background because my attitude is it's hard to get rich quickly, but if I'm in the real estate game and just head in, game face on for 20 years, I have a very high probability of retiring early, having a great lifestyle and great assets. That's what I've seen people do, right? And so that's my mindset I'm coming from is that 20, 25 year macro, I'm gonna win in the long run. So what ROE does is this helps investors look at how their rental properties are performing today, not when they bought them. So for example, many real estate investors, myself included, we get anchored to, I bought this amazing deal at this amazing cap rate for this little down in 2015 or in 2012. Right. That is what it was then. What is it now? Right. And so, we all look at return on investment. So return on investment is, hey, what's my return when I put down 20,000, 100,000, or whatever deal you do? Hey, what's that return? That works great for year 1, year 2. But once you get past like year 3 or 4, you start having the equity build, right? You're paying off principal. You've probably forced appreciation. The market's appreciated as your equity is building. So it's a way to analyze how your property is performing on equity. So here's a really stark example. So going back to this condo I bought, right? I put 0 down. When you have 0 in the denominator, it's an infinite return. My first money in was not until 4 weeks after for my first mortgage and HOA payment. And so I was truly 0 down. So I was like, I have an infinite return. Why the heck would I ever sell this? Fast forward 5 years, I'm cash flowing $200 a month, which is fine. I've got 7, 8 years left on the note. I was like, oh, but I have $200,000 of equity on here. When I look at the current performance, I have infinite return on investment, but my return equity, which is cash flow, appreciation, principal paid out, the way of winning real estate, that was about 7%. So think about that. It's weird, right? Infinite return on paper, but since I accumulate equity, about $200,000, I was making 7% on that opportunity cost in the real estate piggy bank, if that makes sense.
No, that makes a lot of sense. It means that you should constantly be evaluating your properties to see if it's still serving you well today, right? Essentially is what you're saying. Is it the best use of your money today? It was probably an amazing benefit for you when you first started. And then today, is that the best use, right? Is there an opportunity cost? Perhaps maybe should that property be, or that money or that equity, now that you've gained it, be utilized somewhere else for better gain? And that's an awesome way to think about it. I've never really thought about it. I think we've talked about it like conceptually in a different type of context, like, oh, that was good for you then, but does it still make sense today? But I love how you actually quantify that by calling it a return on equity type metric. So that's a great tip, first of all, for everyone here. I mean, even if we stopped the interview there and everyone took that to heart and kind of reevaluate the portfolio, I mean, that'd be incredible. So, I mean, that's awesome. How do you decide what type of investment that you want to go into? Again, you've talked more about going the passive way. Is that still more of your focus and where your energy goes? Or are you still looking at some properties yourself to pick up, or how does that work for you?
I'm personally just focused on passive, and that's time constraints, and I think just where the market is. But I want to take a step back and share kind of like the logical path I got there. And this is a really good tip I learned from my mentor, because he's like, hey, you're making about 7% return on equity. So I'm making about 7% on a $200,000 return a year. He goes, let me ask you a question. He goes, what's the historical stock market return? It's about 10%. He's like, your property is making less than S&P 500 index fund. What are you thinking about that performance now? And that's what like stuck with me, where I was like, oh, I need to recycle. I need to rebalance this equity, because frankly, if I'm earning a lower return, for the most part, than I can in a passive, non-liability, non-headache investment, that's a really good thing. Hey, is this worth my time when I can be making more over here? Now, of course, the stock market, you got the roller coaster. You all want, exposure to real estate, but it's a good benchmark. So when I look at like the property, I'm like, okay, my baseline is I could sell, I could invest in the stock market, and I'll get a 10% a year mixture of cash flow and appreciation. Then beyond that, I say, hey, what can I do with the money? I'm in Denver, so like there were three options I look at the property then. The first is I keep it. How do I optimize it? So by keeping it, you can go on there, and for most people, you can only increase long-term rent so much, you can only drive expenses down so much, right? You can only milk that NOI so much. But then you look at, maybe I do a short-term rental or convert my property to an 8-bedroom co-living space. But you're like, that's just a lot of headache. Returns aren't that great. And I'm busy. I don't be managing 8 individual units or manage an Airbnb. So second option is you can pull money out and do a cash out refi and pull the money. Can you get interest rate arbitrage? The problem is doing a cash out refi on a low performing number puts that property into negative cash flow. Well, I am not a proponent of negative cash flow properties, except in very, very, very rare unique cases where there might be some huge development appreciation pop, right? For the most part, do not hold negative cash flow properties. So the third is, can I recycle it? And give you an example back to that condo I no longer own. In 2017 or 2018, I sold it, did a tax advantage 1031 exchange, bought a fourplex. My cash flow 5x to $1,000+ a month. My ROE was in the low 20s. It was great. The problem now is look at doing a 1031 into high interest rate, mediocre deals. My numbers are just not that great. They're not attractive. They're 10% ROE numbers, and a lot of times less cash flow because of the debt, unless I do major heavy value add. So I'm like, all right, I want to stay within real estate, so look at going passive. And then you look at, hey, I can invest in different types of passive investments. Now, what about passive investments is you can choose what you want. Do you want cash flow? Do you want tax benefits? Do you want capital gains through appreciation? Peter, when you're on the Passive Pockets podcast, we spent a few minutes talking about some of the pref equity deals that you guys were putting together. And I think they were paying like low to mid-teen cash flow returns, right?
That's right. I mean, it was like anywhere between, you expect somewhere around like 12% or 10% or something like that, at least current.
Yeah. And so I've personally know a lot more like income deals where it's just more cash flow. So I look at things as I'm, in this arc, I still want growth, but I'm now worth something. So I want to prioritize preservation of capital, which, I do a lot of debt funds. There's income funds are typically like lower profile and risk on where they are in the capital stack, like pref equities, less risky than equity, senior debt's less risky than both. So you get some capital preservation in there. But most importantly, you just get cash flow. So I have shifted a lot of my investing over to recently now to cash flow, like those type of investments, to go out there and get double-digit returns. I'm very happy with that right now.
Yeah, I think that's the way to go. I think a lot of, at least in our community with physicians, like they're just looking for additional streams of income, which can ultimately determine how do you pick up that extra shift? Do you give up that holiday? It's all money at the end of the day. And if you're getting that check from somewhere else, then you can make better decisions. And I think that cash flow thing that you're focusing on, of course, I've always talked about it in the beginning, like where my focus was. And then, of course, you get into real estate, you look for different opportunities, but then it always comes back to cash flow. How much is coming in to my bank account at the end of the day from these investments? And we've been through a little bit of a crazy cycle, and we're still going through it. By no means are we done with it yet. I'm just curious, in your world, like with the way the current market is today, like how does that shape the way you think about how things are going to go over the next 3 to 5 years for people? And what should people, at least in your opinion, like what should people be looking for?
I think there's going to be very select opportunities in direct ownership. And it obviously depends what market you're in, but like, single family homes, except for very few markets, those properties and prices aren't distressed.
Mm-hmm.
Now on the passive side, the syndication passive fund side, that's where we're seeing a lot of distress. Like we're seeing some of the early deal flow of real distressed multifamily. Until this year, I had not seen real distressed multifamily until like February of this year. Where banks are forcing properties to the marketplace. So I think we're in early stages on there, and there'll be some great buying opportunities. And within there, I have focused more on like some Class A assets. Like I'm moving away from like your typical value add Class C to more like Class A in terms of like, say, some property projects that are, ground up development building, but building Class A. And I think there's also a lot of good opportunities out there where there's a lot of distressed new builders, or I'm sorry, home builders with new builds. They don't have 30-year fixed debt at 2.9%. They've got their 80% loan to cost, 7% interest rate loan, 7% interest rate loan where they need to sell some of those properties. And I think there's some good buying opportunities to develop or buy those and have like Class A rent. So I think there'll be some select opportunities in multifamily. I think we'll start seeing more and more next year. I think we're still bottomish, or maybe we'll fall a little bit more. I think kind of like we're in that 2009 type time space single family was. And the other big thing is like debt funds, or different ways going out there and providing liquidity. Pref equity, debt funds. I've done a lot with debt funds. I understand them very well, and I've got a lot of great contacts in that space. But I see a lot of investors want that type of profile. They just want cash flow. Yeah. And then, flippers are seeing some great deals. Professional investors seeing great deals. And as banks are, they have tight lending guidelines, it creates more opportunity for like private lenders or hard money lenders, while they double your cash flow and a safer position in the capital stack. So yeah, I think multifamily distressed, and then income funds are kind of like the two big things I'm keeping my eye on.
I mean, that's awesome. Let's say somebody's listening to this and they want to get started, and they've been thinking about, how do I start using the capital, the hard-earned capital, they put in time for it, and they want to create passive income and do that and get into that world. Like, how does somebody even get started?
Great question. I mean, that is, first you got to start with yourself, right? Hey, what are your goals? What's your risk profile? What do you and your spouse, your partner want? Like all that stuff, like know where you want to go. If you have a clear destination, you're not gonna be able to make the right investments. So start there, standard goal setting, and review your finances. But then my recommendation is from like a tactical point of view. My first checks from the multifamily, I recommend people like look at debt funds as their first investment, because inherently there's usually lower risk because there's 40, 50, 60 loans in there. That debt fund's operating usually for, years to decades. And then you also get immediate cash flow. So it's nice to see, hey, put money in, I get cash flow out in 60 or 90 days and every 30 days after that, right? Where, hey, so there's multifamily deals, you don't see cash flow for 2, 3, 4, 5 years. So I would put that on people's radar as like a good place to like start, and then go ask for like a lower minimum, and then go check your network, right? Peter, I know you guys do some deals. I know you're a great community. Like I would start with communities like that, like people to put a plug in for Passive Pockets. Passive Pockets focuses on helping to bring like sponsors deals and getting eyeballs on them. And there's always a handful of debt funds over there. So you go to places like that, start looking for deals, and then start underwriting deals. Don't invest the first deal you do or you look at, just like you don't buy the first rental or you don't get married in the first date, right? Look at a few properties or syndications, and then, hey, make a goal to write one check in 100 days as you've gone through proper, due diligence, of course.
It's great advice. I mean, I know some people, again, are listening to this and they want to connect with you in some way. You mentioned the podcast. Maybe you can mention it again where people can find that. And then also, how else can they connect with you?
Yeah. So, I mean, go to passivepockets.com if you want to go out there and get plugged into, seeing some of these deals and that passive community. And then if you're interested in like optimizing your return on equity, go to propertyllama.com. That's actually the software tool we built that helps people actually analyze their ROE on their properties.
All right. Incredible. Any last words in terms of advice for maybe a big tip for someone in, let's say in 2026, they want to make the most of this opportunity in this market? Like maybe what's a tip you have for them?
Get very focused. I think a lot of people have not gotten refocused in the current market reality. So like do a 360-degree evaluation. Look at yourself, look at the market, be frank with where your best time is, measure how much your time is worth at your job or when you're doing a property or a deal. And there are people into passive. The best way to get good at passive investing is to look at a lot of deals and underwrite a lot of deals. I get a lot of people saying, hey, I want to get the passive investing. How do I start? I'm like, it's the same thing you did when you bought your first rental. You probably underwrote dozens or hundreds of deals. you underwrite, not hundreds of passive deals, but go out there and underwrite a dozen or 2 dozen deals, understand how they work. Because it's those repetitions that give you confidence and helps you start understanding, hey, this is a good deal versus a bad deal. So my biggest thing is be very intentional and go out there and just look at more deals.
All right. Well, this has been a great talk. I appreciate you sharing your life history with us, all the stuff you've taught us. Again, tons of value that you gave us through this interview. I appreciate what you're doing again with the Passive Pockets podcast. It's awesome with what you're doing. Just keep up the amazing work, and looking forward to talking again soon.
Thank you, Peter.
All right. Thanks. Bye.
Enjoy the show? Let me know by dropping a review in the podcast app you're listening to us in. And if you haven't already, make sure to hit subscribe. Join thousands of physicians who are also on this journey to creating their ideal lives through multiple streams of income. Learn more at our website, passiveincomemd.com. Thanks again for allowing me to be a part of your journey. See you next time.